Welcome to this quick guide on accounting for bonds under IFRS and IND as 109. Financial instruments can seem complex, but I'm here to break down the essentials for bonds in a simple, straightforward way. So, what's a bond? Simply put, a bond is a debt instrument where an issuer borrows money from investors for a set period. The issuer promises to pay interest, what we call the coupon, at regular intervals, and to repay the principal, or face value, when the bond matures. Think of it as a formal IOU with extra steps. Now under IFRS 9 and IND as 109, the real game begins with classification. How a bond is classified determines how it's measured and where changes in its value are shown in the books. There are three main categories, and each has its own logic. Let's start with amortized cost. If your main goal is to hold the bond and collect the contractual cash flows, this is the category for you. It's a classic buy and hold strategy. But there's a catch. The bond's cash flows must be solely payments of principal and interest, what's called the SPPI test. When you first recognize the bond, you add any transaction costs to its fair value. Then, you measure it at amortized cost, using the effective interest method to account for interest income over time. Next up is fair value through other comprehensive income, or FVOCI. This comes into play when your business model is a bit more flexible. You're collecting cash flows, but you may also sell the bond. Again, the SPPI test applies. Initially, you add transaction cost to fair value, but after that, you measure the bond at fair value. The difference here is that gains and losses don't hit your profit and loss directly. Instead, they go to other comprehensive income, which sits in a separate section of the equity. The last category is fair value through profit or loss, or FVTPL. This is the default bucket. If a bond doesn't fit the criteria for amortized cost or FVOCI, it lands here. It also includes bonds held for trading. Here, transaction costs are expensed immediately. The bond is measured at fair value, and all changes go straight into your profit and loss statement. You might be wondering, are IFRS 9 and IND as 109 really that different? Actually, when it comes to bond accounting, the two standards are almost identical. Both follow the same classification model based on the business model and the SPPI test. While there might be minor contextual differences, especially with regulatory interpretations in India, the core principles are aligned. So, why does all this matter? Well, proper classification directly impacts how bonds appear on the balance sheet and how their fair value changes flow through the income statement or OCI. It's not just compliance, it's about presenting a transparent and accurate picture of your financial health. To sum up, three categories, each with its own rules for measurement and for recognizing gains and losses. By classifying bonds correctly, accountants and finance professionals ensure reliable and clear financial reporting. This framework is what brings order and transparency to complex financial instruments. If you want to dive deeper into the world of IFRS and IND as 109, there are plenty of resources out there to help you master the details. Thanks for watching, and remember, when it comes to bond accounting, clarity is key.